Richard, we're live. We're live. Are you there?
I'm here.
Oh, good. Good. Glad to see you here. June 29th. It's almost the beginning of July. I can't believe I don't know where the time's gone. And it's almost time for the summer doldrums. I remember back when I was in the day when I was trading, scalping full time. Boy, oh boy, summer days. Sometimes I'd come in and I'd trade the first 20 or 40 minutes and then I'd just take off and I'd come back at the close because nothing was happening.
Hmm.
And we've got an interesting time right now, I think, in the markets. So we can talk about that a little bit. Let's let some people come on board here. Where are we at? All right. Where's everybody from today?
Hey, Andre, and
Oh,
Def,
yes. I've got
and Giandrea. It's our Prince of Italy.
Is it the Prince or is it the Mafia? I'm not sure.
Yeah,
Either way, it's kind of cool to have him on board. So I'm pretty happy with that.
with your tomato.
All right. Okay, let's see. We're getting a few more people on board. Excellent, excellent numbers going up, going up, going up. Love it, love it. So today I did a little poll, as many of you may or may not know. Friday is expiration time. This is the Friday at the end of the month, which are always bigger. Sometimes you get these quarterly ones as well, but tomorrow's options expiry is pretty big. I can't remember how many billions or whatever worth of options are expiring, and sometimes those can have a significant effect on the market. So I've got a little poll here. Let me publish. I think I've published it. So, do you think tomorrow's option expiration will A, move the market up, B, move the markets down, or have little effect on prices? Me personally, I think they're going to have little effect. One thing that we can look at, and actually Richard and I were discussing this before the show, is we're always looking at volatility. Where's the volatility? What's going on? Well, that's a gauge of sentiment, right? What people think are going to happen, or uncertainty or fear, right? So we can see the volume, the vol is just low, 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 low. A lot of times, right before options expiry, just like if you're trading a stock, right before earnings, a few days before earnings, the volatility will rise because nobody knows what's going to happen, right? Like good earnings, bad earnings, what's going to happen? A lot of times you can sell that volatility, hoping that there's much ado about nothing, and you get what's called the vol crush. The vol goes from 65 to 45, too sweet, and you collect all that beautiful premium. I personally think that not too much is going to happen tomorrow. Richard, what's your thoughts on tomorrow's option expiration and its effect on prices and volatility?
So we have been discussing this at length, actually, where I work, and I think our view is that the markets are so thin and so devoid of enthusiasm in terms of retail people thinking that Bitcoin is going to go to the moon, that all that's left are institutions sort of selling structured products, and which tend to be short vol, and miners selling covered calls, to be general about it, and that's crushing vol, and that means that market makers probably tend to be long vol, and they do benefit if they can move markets around prior to the expiry. It just, I guess, depends on whether there's one with enough firepower to do that. I think probably it'll just kind of be much as it has been for the past week and just go sideways. What I'm more actually interested in and concerned about is what happens after, because we've seen this sort of over 2 week cycle where we've been rising up from, what was it, down to 25k or 26k Bitcoin up to 31ish. Quite a big move. Made me work actually for my money, and and then kind of just stopped, just kind of stuck here, and it's it's like, I guess it was the EDX news, the news that the EDX exchange is coming out, and then that BlackRock and a few others are starting applying for their funds for Bitcoin. So everyone thought, oh yeah, Bitcoin's going up. Let's cover our and I think actually what happened is the institutions just covered their short calls. And
could be.
Bam, market. I don't think a load of money piled into the market to buy Bitcoin. I mean, some came in from MicroStrategy, but probably not enough. So I think we'll just get stuck in another rut until the next bit of news comes out, and then we spike up or down again, and that's how it's going to be, I think.
Yeah, and if we look at the pattern over the last year, the smart move is to wait for something to happen. Okay, the market makes a 12% move or whatever it does, and then it trends sideways for a few weeks or maybe 2 months or whatever. And there's an excellent opportunity there, I think, when we get that big move, to assume that it's going to be somewhat of a sideways trend channel after that, and maybe sell our condors short term right there. Or if we've been stuck in a trend for a while, we know it's going to bust. Okay, let's go long gamble. Let's put a long strangle on or something, whatever we're going to do, or long iron condors. But so if we're taking a look at the results of the poll, we got 40% of the people saying that they think it'll have little effect on prices. 33% think it'll go down, and 25%, those diehard hodlers, think it's going to go up.
Okay, so the jury's out then to sell calls.
Yeah, there we go. There we go. Okay, I think we're ready to rock and roll. Let's see here. We got. Okay, all right. So today's agenda. What do we got going on? Let me just take a look here. What are we doing? Well, we're going to do our market analysis. I don't have a ton going on, but I'm going to share my positions, what I have. Lots of stuff I've scaled out of this week. Tons of stuff that's expiring June 30th. So I'll share that. I got some stuff in July. Then we're going to talk about adjusting covered calls. Again, covered calls are a great place for beginners to start, and they can be good long-term consistent earners. So that's what we're going to do. So let me hop over to my silly charts, and I'll get started. Then once I'm done, then Richard, you can jump in and join us. So let me go ahead here. Actually, last time, if you remember, my thing didn't work, and maybe it's because I didn't stop sharing my slide presentation. So I'm going to stop sharing that, and I'll share my screen and see if that works. Well, I could share my screen last time. I just wasn't able to draw on it. So can you see my silly chart?
I can.
All right. So those of you who are been with us for a while, you might recognize, can I draw on it? Oh, look at this. I can draw on it. Beautiful. Wonderful. You can see that I've added something to my silly chart. I have added this little thing up here, this pink channel. Now, what is that? Well, whenever you're charting, you want to look left, right? You want to look left, you want to look left. So if I go back to, let's say, a daily chart, for example, here, let me reset that. You can just see, the market found some support, and then when we had that big breakdown last spring, that's where I've drawn my very simple, it's the silly chart. We're not going to get crazy into charting. I've drawn a very simple support up there. And what I should do is I should actually take this. Can I copy this unicorn? I think so. Yes. Let me paste another unicorn up. Oh no, that's the wrong one.
You got a wonky unicorn there.
Yeah. Unicorn's up here. And then why is my unicorn up there? Well, I tell you what. And this is practically the same thing on ETH. So I was looking down here for, we were waiting for this thing to break for all this time, for months and months and months. It looked like it might break down, but it touched my line, right? Touched my line and then went up. Yes, there's some news there. But I was hoping we'd get down around this bottom levels down here. And my unicorn is just when we're going to start to take some action. We're going to look for opportunities. I am a counter trader. I trade counter trend most of the time, not all the time, most of the time. And that's what these unicorns are for. If we break out of this area here and we decide to go up, use my little thing, boom. This is exactly what the market's going to do. 99%, this is exactly what's going to happen. The market's going to go up to somewhere up in this area up here, or it's going to go sideways for a while, or it's going to go down as far as this level, and that's it.
Wait a minute. You can't tell people it's either going to go up or down or sideways. That's, of course, one of those is true.
Yes, but I'm saying where it's going to go to, Richard. Where? Okay. If we get up in here, we're going to bounce around and fart around, even if it does break up eventually. Just like if we go down here, it eventually breaks down. It's not just going to go straight through it unless there's some crazy news play. So this is what's going to happen. We both kind of expect a little bit of sideways action. We just talked about that. Like if, this might be a great time to sell some condors, here and here, expecting this thing to go sideways. I'm not saying to do that. I'm just saying this is what I expect the market to do because the market moves level to level. Okay. So that's what I like in Bitcoin. Now I've closed my Bitcoin positions, but I do have some Ethereum. And you can see on Ethereum, I've also added a big area up here, resistance. And I've got this little area of resistance up here where it previously hit back in April-ish sometime. So here, what do I expect to happen? Well, I expect if we go up here, we might fart around. We eventually might bust through. But if we can get from this area here up into this area, that's when I'm going to start to take some action. That's when I'm going to really start looking for. Oh, I should put a unicorn up there. And the same thing can be said on the downside. If this thing goes down, I would not expect it to just easily break through this level. I'd expect some farting around and then a bust down, or just as easily bounce up into the range. Again, I'm just trying to demonstrate that's level to level because what I try and teach new option sellers is let's just be patient, wait for stupid things to happen, look for nice areas of support resistance, horseshoes and hand grenades. We don't need to be exact on our entries. We just need to be close and we'll collect all that beautiful, beautiful premium. So let me just get rid of this and I will probably go over to my chart here because I want to see what I have open. Ethereum. So starting on Monday, now I had some June. Actually, let me just adjust our photos. I'm going to make you a little bit smaller there, Richard. I hope you don't mind.
No worries.
So I have some room to chart on here. So let's see, June. I mean, we're right at the end of June right now, right? So I could draw a line right here. Can I draw a line?
I can't see a line.
Oh, there, right? Can you see that line?
No, you're still sharing your SETI chart.
Oh, am I? Okay.
Oh, no, wait, stop. The line's disappeared.
Oh, okay. Yeah, let me
now the SETI chart's disappeared.
No, I'll put it back on. You should be able to see it now, right?
Yeah.
All right. And you can see this vertical line.
Yeah.
That's expiration, right? That's the end of June. Oh my gosh, that's tomorrow. That's right, tomorrow. So what did I have? Well, I had a whole bunch of 2,000 short calls. I've got practically nothing left of them now. Where's 2,000? There's 2,000 there, right? So as long as we stay below there by tomorrow, I'm golden. We're going to collect everything from that. I think I have 1 or 2 contracts left. I started buying them back on Monday, and it was about 50% ROI. Now they're about 93, 94, 95% ROI. Got the minimum bid in. Maybe they've gotten taken out this afternoon. I don't know. And I still do have. Let's see here. Let me clear this off. What else do I have? I have some July 7th. So if I take a look at the chart here and I go July, let's say about 7 right there. That's the expiry. And these are 2,000 short calls. Again here. That's what I'm looking at. As long as it stays within that little box, I'm golden for those. Now, these July 7, 2000 short calls, they were about 30% ROI, 38% ROI on Monday. I started scaling out of them. Now, this morning when I checked, they're around 65% ROI, only a handful left. So during the week, just ding, 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 ding. I layer my orders down, take them all out, take that risk off. I'm happy to do so. What else do I have? Now, I've got some July 28th. Now, I'm going to be putting some other July contracts on after tomorrow's expired. I'll explain that in a second. What have I got for the end of July? Where's the end of July? It's over here. So we can do like this, right? There's a July expiry. That's our date we're going to bump our heads up against. I have 2100s, right? So around there, 2100 calls. I have some 2,400 calls as well. So end of July, we'll see what happens. Now, these 2,100s, they're about flat this morning, ROI. So right around 0, no showing ROI. And the 2,400 calls are about 30% this morning. So I will probably look to start scaling out of those when they get around 50% ROI, unless, of course, the price decides to shoot up and I have to manage it. Not a big deal. So that's what I have short right now. Now I do have some July 28th, so I'll put this thing here. I do have some 2,300 calls long. I've got some long 2,300 calls, and that was actually part of a previous position. Now I'm holding on to those. Now, right now, those I think are about 40% against me. But what I'm going to do with those is so just so everyone knows, I generally have a general rule where I will get rid of options, long options, that are about 50% against me, unless they're serving some other purpose. These, if they get 50% against me, we keep going sideways, well, probably in another week, they'll be about 50% against me for sure. But until that period of time, I'm going to sell some calls against them. What I'm hoping for is maybe the market can make a little bit move up, increase the value of these 2,300 calls, right? That's 2,300's up there. And I will sell. Maybe I'll sell lower. Maybe I'll sell a little higher, but I'll sell the same expiry. So I'll sell some more 28 Julys to make those 2,300s pay me. Okay. So I've got the protection. So I'll turn that into a vertical spread. What else do I have here? I think I have some Septembers. So September's way out here. It's behind Richard's head. So let's just say September's out there. I have some 1,700 puts. So I've got some 1,700 puts right there. Now, these puts, they're about 34% against me this morning. Again, with these puts, what I'm looking for is a bit of downside protection. I don't know, maybe I'll take them off and I'll buy some new ones if they get about 50% against me. But if the market does take a little bit of a move down, wonderful. I can use those puts and I can sell more puts and turn that into a spread. So I don't just blindly take them off. Sometimes I've got little leftovers from different positions. It just depends on what's going on in the market. If we continue going sideways, which we very well might do, both those long calls and long puts are kind of going to be a little bit of a liability. Yes, I can sell some against it. Is it enough? I'll sell something against it for sure. It won't be a lot, but I might be inclined to just take those positions off. Richard, that's it for me in terms of what I got going on.
Yeah, sure.
Do you want to share and talk about what you have happening?
Yeah, I can show you what's going on in my book just quickly. You see that? So you can see I'm committing a bit of margin abuse.
I just see you, Richard. I don't see anything else.
Oh, okay. 1 second. Share screen on. Choose tab.
Yeah, there we go. I see it. Yep.
Hang on. Which do we see a purple screen or a white bar?
I see your black Deribit screen.
I
see your mouse moving on it now.
Hey, okay, good.
Yeah.
Right. Yeah. Let me just. Sorry, everybody. That's right. Okay, that's me. And where did I go back? I've lost my tab. I've got about 6,000 tabs open.
This is tab abuse.
Yeah.
And then when you really need to find it,
there it is. They changed the icon. Okay, got it. Right. So these are my positions for expiry tomorrow. If you were watching last week, you will remember that I had short calls smeared all across 30th of June. And what I've been doing is systematically buying back any option that was less than 44% vol. So you can see the volatility in this white column. So the vols are actually going up, being bid up for tomorrow's expiry, which is understandable. It's a big expiry, and there'll be lots of incentive for people to sell options into that. So the vols are going to get marked up. So I'm kind of 47. I don't really want to buy it. I certainly wouldn't sell it, but I've already got it, so I'm going to leave it where it is. These other ones up here at 32,000, 33,000, I'm going to wing it and see and just and I've got, if we go up there, I'll hedge, but I don't think we will. And the ones that are in the money, they're already fully hedged with futures, so they'll kind of go out worthless. I have been again systematically eviscerating everything around the money. I've been buying back. I've been paying. You see, we're like 40, bidding 41.7 and offering 44.3. I've been bidding 41, 42 vols to get all these positions back.
Where did you sell most of those positions at it, Richard?
They were sold 10 60. Delta when they were like 60 or 70 vol.
60 vol, okay.
And again, 14th of June, same story. I've got some short call, well, most short calls and a few. Sorry, yeah, July 14th. And a couple of puts that I kind of sold when they were 50 vol. And just before I come to July, I'll just tell you why I'm doing this. So here's the DVOL index. This is the implied volatility 1 month index. And what this is telling me is that regardless of that spike at November 15th, vols are just getting crushed. And that panic we had last week where BTC, was going to go to the moon again, you see at the end of this chart, all it did was increase vols by about maximum 15 vols for 1 day. And then they got crushed again, and they're almost down to where they were at the bottom. So we're currently 6 vols above the bottom, right? And I fully expect that 46 to become a 40 before too long, as systematics and structured products and vol sellers are just selling the vol. But at the same time, if you look at the historic volatility of Bitcoin for the past 15 days, well, that's bumped up from sort of 35-ish to 44, and I see no reason why that shouldn't stay elevated, maybe come down to 35 again, then bump up again to 44, 45, or even go higher if things start panicking. And I am not going to be the mug who sells like 46 vol at the money, only to find that realized vol's 44, and I'm paying 10 vols in hedging and costs, and actually I'm suddenly 8 vols offside. So I'm not going to. I refuse to sell any vol that's less than 50 right now.
Richard, just so you know, Def is just asking if there's devol for ETH as well. You can just toggle that little switch on the top there.
Yeah, devol, select ETH. There we go. It's the same picture. It's all the same, right? This is all. I'm actually not a cryptophile. As far as I'm concerned, crypto is just stuff to trade. You can flame me all you want. I'm a bit of a barbarian in that sense, and you can also see the historical vol on ETH as well, and it's pretty much the same as Bitcoin. It's slightly higher, but it's the same story. And actually, the numbers are pretty much saying you shouldn't really be selling vol on ETH less than 55, in my view. So translating that back to the 14th of July, say 2 weeks, where's 50 vol on Bitcoin? At best, 15 delta, right?
What's that, 34,000 or so?
Yeah, 34,000. Yeah. Or in my world, 10% up. I see that as a 10% up move, right? And on the puts, where have you got to go to get 50 vol? Well, good luck. You've got to sell 6 delta, which means you've got to sell a mother load of premium of notional to get any premium at all. And so for me, this is like becoming a really dangerous place to start selling vol right now. So I will right now I'll manage the positions I've got, but I'm putting on no more risk. One thing I did do this morning was a bit of experimentation here. I've been playing around with a 1x3 call spread. So here I sort of bought the 0.1 of the 40 delta 32,000 call at 44-ish vol, and I've sold 3 of the 34,000 against it. I did the same with the 3250 and the 35,000. And remember, for me, this is a pure vol play. So what I'm looking to do is capture the long gamma around the long positions here, but hopefully never pay for the short gamma in the higher ones. I've also then thought better of this. Actually, I did as a small debit, and then I sold the 36,000s to get some premium in to pay for it all. So this is all roughly delta premium neutralish, this position, and it's pure vol play. And I'm really just looking for something I can do to find some way to eke out some kind of return from the market at the moment.
And it's interesting, Richard, because we were talking before, and we were talking about, well, maybe this options expiry will have a bit of a vol increase. It doesn't seem like it, because a lot of times you look for the vol crush. And I said, well, there will be no vol crush. But you said, well, vols might keep getting crushed. And it's true. We're sitting at 40-something%. We could be at 38% next month, and that might be the new norm. I mean, who knows, right?
It's the same story, right? The markets go up until the last bag holder is holding the bag, right? And the same as with vol. Vol will sell off until the last jump has sold vol too low, and nobody else has, right? And I just don't want to be that guy. So the play here with this, the long gamma around these long calls is not actually to try and make a profit because I think Bitcoin's going to go above 33,000. I actually don't, although I could be wrong. Right? Actually, the reason I'm holding this gamma is so that I can actually trade futures around these positions, and basically market make futures to try and make a bit of cash.
Okay. I think it's important for people to realize that right now, these are hard markets to trade.
Yeah.
There's not a lot going on. It's not like we've got these big swings happening every 3 weeks and lots of high IV. So just, don't beat yourself up if you're having a tough time. And we were also, another thing we were talking about before the call was even in the TradFi markets, if you're trading commodities or equities or indices, it's tough. It's very, very tough right now. It's just kind of this sense, this pervasiveness across all these markets. So I don't want anybody to beat themselves up. Richard,
we'll do a special about this, right? I think maybe next week.
Yeah, I think we're going to talk to the good folks at Dare a bit about putting something very special on how to trade this market very specifically, because there's a couple ways to look at it. There's way you're analyzing things, trying to take off those little edges, and just easy. And there's also my way of looking at it, saying, let's just sit on our hands and wait for opportunities to appear versus trying to push things. And I think both are smart ways to approach the market right now, because we just don't want to overtrade. And it's so easy to overtrade, or it's so easy to try and make something happen, and you forget it's not going to happen.
You've seen that my margin use has gone up to 60%, which is well above my normal range, and I like to leave a lot of spare capacity so I can sell more risk if vol does spike up. So I'm just waiting for tomorrow's expiry to be out of the way and all that risk to be gone, and then I'm going to be keeping the uses below 40% until I see an opportunity. But we've taken way too long to get into the meat of the course today.
Aha! Okay, yeah, we're half hour in. Let me go back to the slides, and we'll talk about adjusting covered calls. This is good stuff. This is good stuff. Okay, so when we're talking about, and when I was showing my positions earlier, all those calls I've sold, they're all covered. I do not even lose a wink of sleep worrying about it. If Ethereum was to go to 3,000 tomorrow morning, I'm just going to lose out on a bit of profit I would have otherwise made on Ethereum rising. So everything is covered right now. So generally speaking, when we're talking about covered call profits versus naked calls, for example, we will look to extract a lot more profit. If we're talking about maybe a weekly, or you've got 2 to 5 days to expiry, well, maybe I'll look to just take 25% out if that's my days to expiry. If I'm looking more longer term, maybe a 50 day to expiry, 55. Well, I'm probably going to look to try and pull about 90% of that premium out. Similarly, somewhere in the middle, if we're about 2 weeks out, well, 50% target, I feel very comfortable with that. We can be more aggressive with these ROI targets on covered calls versus naked because they're less risky, right? A little less aggressive. So let's talk about just rolling, some features of rolling to start. And this is a little bit of a review, but we can talk about rolling out in time only. So we've got a covered call and we're nearing the expiry. We can always look for rolling out for a net credit, regardless of whatever the underlying asset price is. Okay, if we're rolling out in time only, we're not rolling up, we're just rolling out. If it's in the money, and the further in the money, the net credit received is going to be a little bit less. If the underlying price was at the money or out of the money, and like Richard last week or the week before demonstrated how, really at the money is sort of the optimal time to roll and get the most bang for your buck. Now, I will mention here too, if your call is in the money, okay, so the price has moved up above your strike price, that risk profile is the same as an out of the money short put. And you may choose to convert it to a short put because it's a little bit easier on your margin and it's a little bit easier to get your order filled, because we know sometimes if you're deep in the money, the market can be a little bit lean. It can be a little bit tough to get filled. Now, if we're keeping the same strike and we're just going to roll out in time or only, so we're going to give ourselves more time, and especially if the underlying is close to the money, you're going to collect more premium and you're going to lower your cost basis. Okay, it's going to reduce that risk profile a lot more significantly. Now, if there's a significant smile or a skew, you may want to take advantage of that. So here's what I'm talking about, the risk profile for a short put. If you remember back here, I mentioned if the call's in the money, that risk profile is the same as an out of the money short put. So let's say the price is here, you decide to sell a put. Well, here we are. Here's our max profit, premium we received anytime we're selling, and our break even is the strike price minus whatever premium we received. So it's the same as having a short put. So if we're rolling out in time only, if we're at 29,000 in Bitcoin and we're going to roll out another 30 days, for example, okay, well, we're going to get the most bang for our buck, right? We're going to get a lot more money than if we're rolling out and up. If we went to 30, 31, 32, 33, that would be rolling out and up, okay? So we're talking about a lot bigger premiums. It's going to reduce our cost basis a lot more. So in this case, we're talking about $2,200 more reduction in our cost basis, because remember, we're talking about covered calls where we own the underlying, okay? So when would we do this? When would we roll out in time only? Well, when we're bearish on the underlying, but not so bearish that we just close the underlying position. Because if I'm super bearish, if I think crypto is going to collapse and go to zero, I'm not going to do any of this stuff. I'm just going to sell my crypto, and I'll wait for a different opportunity. So we're not that crazy bearish, but we're bearish on the underlying because we don't think there's much upside potential. We're willing to take that big premium in exchange. So next is another standard roll, rolling out and up, and I touched on it. It's a little bit more aggressive, right? We're giving it a bit more room to breathe. And you want to do this for a credit or a flat whenever you can. And you're increasing your profit potential, the profit potential of the underlying, because we're moving that cap a little bit higher up in price. We're giving the stock or the underlying asset, in this case, crypto, more room to breathe, okay? More room to appreciate in value. Now, if that short call is out of the money, which is what we want, right? This adjustment is replacing intrinsic value with extrinsic value, okay? Now, again, Richard showed you the smile a couple of sessions back, and it's easier to roll an out of the money or an at the money versus an in the money option. So here we are, let's say Bitcoin's 29,000. Well, if we're rolling out and up, hey, we might be selling the 33,000 or the 31,000. The further out you get, right, that's less premium you're going to receive, but the more opportunity you're giving that underlying asset to appreciate in price and make you money. Rolling out and up, when are you going to do it? Well, when you're a little bit more bullish, right? You want to give it more room to breathe. You want to capture more upside potential. And the caveat is, of course, we'll receive a little bit less premium for that short call. What if your strike is in the money? And I get this question all the time. Well, if you're doing a standard roll, you know what? You might just need to eat it. You might need to do that roll at a debit. That might happen. You just find a strike and a premium that feels comfortable. You can still be aggressive. You can still roll out as far as you want. You're just going to collect that much less premium, right? So it's not the end of the world. It's going to happen sometimes. Maybe you're fully intended to roll when it got approximately your price, but overnight the price moves and now you're $1,000 underwater on the short strike. Well, what can you do, right? If you want to roll it, you're going to roll it. It might have to be done for a debit. Just know that if you roll for a debit, instead of decreasing our cost basis, which is the point of doing these covered calls, covered call campaigns, you'll be increasing your cost basis a little bit. Let's say you're doing a campaign for 9 months and 1 or 2 of those months, you had to eat it a little bit. Well, whatever. We can't make money every single month, no matter what guaranteed. Sometimes that's going to happen. Don't worry about it. It's covered call. It's not like you have unlimited loss on the upside, right? So if your short call is in the money, you may need to roll for a debit. but your cost base is increased. So let's say your short strike is 30,000, current market price is 1,000. Well, whatever that's going to cost you, you're going to have to add it to your cost basis. If you bought a Bitcoin at 25,000, we're going to have to add that debit onto that 25,000. Okay. When are we going to do this? Well, when you have to. No other way to put it, when you got to. You could just take it to expiry, take that hit, and systematically sell again. And a lot of people do that on a campaign. They'll just take it to expiry no matter what. What comes, whether it's equities, whether it's crypto, and then just roll it again. Take it to expiry, roll it again. Some people do that. I think that there's situations where you probably don't want to do that. So, for example, if that short call super depreciates in value really, really, really quickly, you're better off just to take it off the table and not let it go to expiry. But we don't need to get into that today. Any loss you're going to be taking is pure intrinsic value, right? So not every covered call is going to expire out of the money. And you won't always be able to roll it in time. Sometimes you just kind of got to do what you have to do or what you can. That's simple as that. Let's talk about some other adjustments. Now, what I just talked about were sort of your standard everyday rolls. Pretty much everybody knows about them. Nothing too special. We just talked about the parameters. Fine. Let's talk about some other things we do because I think we do them just as often as we will do standard rolls, okay? And it's going to depend on your bias. It's going to depend on your bias. That's why we're doing this, right? If we've got a very bearish bias, if we've just had a big run up or we're bumping our head on some serious resistance, we think, yeah, I don't think this thing's going up much more. Well, we can use the proceeds from that sale of the call to buy a put, and we'll collar the underlying. And a collar is when you sell a call to buy a put. Okay, and this is what it looks like. You're selling. Here's a short strike of the short covered call. So we're selling it here. The maximum potential gain is going to be capped, right? The premium received, and we're not going to make any more money. So if the stock shoots up, well, we've capped our profits at that short strike, that short call strike. But we use the proceeds to buy a put, a protective put. Okay, so we can see how we've collared it on each side. We've got a max amount of gain, but a max amount of loss. And collaring can be a smart thing to do if you're unsure. Richard, you want to say something?
Yeah, you might. I was going to say you might hear that referred to as a risk reversal as well.
Yes. Yes. So if a bearish bias, but we're not so bearish that we're going to just sell whatever the asset is, we can use that proceeds from the sale of the call to buy a put, and we're going to collar the underlying. Okay. A collar, again, is when we sell a call to buy a put. So we're limiting losses on the downside. We're limiting gains on the upside. The one thing I'll mention here is that the long put that you purchase with the proceeds from the sale of the call is most likely going to be further away, further out of the money than the short call is. So it's not going to provide protection usually against smaller down moves. It's more of a big catastrophic. You wake up one morning, the market's down 12%. Well, that's what you've done this for. You've kind of protected yourself against larger down moves. Now, we could also do a couple other things. We could sell a ratio and add some naked calls to the covered call. Now, I wouldn't recommend doing this if you're new to trading or if you can't monitor the markets, if you're not sort of Johnny on the spot. This isn't something we do all the time necessarily, but if I feel confident, if I'm pretty damn confident that price is probably not going to appreciate much further in the current cycle, meaning up to the next expiry, whatever that cycle we're in, whether it's 14 days, whether it's 30 days, whatever that happens to be, then I'm okay doing this. I'm okay doing this because I'm actually okay managing short calls. Now, not everyone wants to do that. Yes, that short component does entail unlimited risk. So we got to, we can't just walk away and go for a beach holiday for a week. We need to watch it. But those naked calls should be treated as such, and you should have a different ROI target versus the covered calls. Remember in that first slide, I was saying, well, here's some of my targets. If I'm selling a covered call, if I'm 50 days out, I'm going to look to try to take 90% of that premium in. Well, if I've got a ratio on and I've sold some covered calls, well, I might be taking those covered calls off as soon as I get 25% ROI, or those naked calls off at 25% ROI. So I'm always going to treat the naked component as a naked component. Now, if we're bullish, we can look at it the other way. We can do another ratio spread, but we can do a long call spread, right? So we can use the proceeds to buy some calls. That's a lot more aggressive. So if we think, hey, man, this thing's just, man, I think it's going to keep going up, or I think there's a really good chance it's going to go up. You've sold a covered call. Well, you can use those proceeds to buy a call and see if that's right. Now, if you remember at the beginning of this, I said I have a rule where if I have a long option position, I'll take it off when it gets about 50% against me. That's not always the case. It's a general rule. And where that rule comes from is it's generally a lot harder to make money buying options than selling options. Why? Because when you're buying an option, you have to be both correct on both timing and direction. If I buy an option and it's now 50% against me, it's 2 weeks later or a month later, whatever, clearly I was wrong on timing and direction. So I'll take the damn thing off. I'll take the rest of the money back, and I'll look for another opportunity. Now, that being said, we can sell options against it and turn it into a vertical. Yes, but I'm just talking generally. So you could do this. You could take those proceeds, buy some calls. So you've got 2 calls for every one you sold, for example. It doesn't mean you have to let them go to expiry. If in 2 weeks or you get 50% down on those options, take them off. Take the rest of that money back and wait. There's nothing wrong. There's the gift of being flat. So I think that's all I wanted to talk about with covered calls. No. There's one more thing. And we did talk about this before. I forgot. If you have no idea what will happen, which is usually me, I'm sort of clueless. I'm stumbling around in the dark. I don't know what's going to happen, right? Okay, maybe I'm a bit facetious there because I do have my silly charts, and they're always right. Always right, Richard. Always right. Don't even argue.
That's one very unhappy unicorn down at the bottom of that chart.
Yeah. Well, it's a unicorn. Nobody ever sees it, right? If it's a coin toss, well, why not split the risk? If we think something's going to trend sideways, or it's a good chance of trending sideways, which happens frequently now, let's split it. Let's sell a strangle, or if we want to be protected, let's sell an iron condor or a broken wing iron condor if you're feeling a little bit pensive on one side or the other. Only one side's going to be wrong. And if it is wrong, we only have to manage half that risk. So that's all I want to say about adjusting covered calls. You got anything to say on there? Hang on.
I did think of something, actually, just as you were on the last slide. I then probably forgot it because I'm getting old.
Hang on. This one?
I can't see. You're still on the last slide. The one before.
Oh, the one previous to that. Oh, the ratio spread, the long ratio spread.
Yeah. No, I've still forgotten what I was going to say. Never mind.
Okay.
It'll come back.
All right. So.
Oh, yeah. I remember now.
Okay, go ahead. Tell me.
You said it's easier to make money selling options than buying them. Actually, this is partially true, but it's also a matter of perception.
Did you just fact check me?
I did. Yeah, I do that a lot. And actually, there's a great, if you've never heard of him, Nassim Taleb, who wrote The Black Swan and Fooled by Randomness, which are great books. I recommend reading them. He has a lot to say about this, actually, because he tends to be a buyer of options rather than a seller. And the reality is that actually, it's actually a function of dopamine. When you're a seller of options, particularly in flat markets, you get a dopamine hit every morning when you wake up and see your P&L's gone up, and it feels good. Feels good, man, right? And human beings are very, very wired to be attracted to regular dopamine hits, which is why we become addicted to sugar, alcohol, you name it, right? But actually, and if you're going to be trading long vol, you have to harden yourself to long runs of small losses every day before you ever see a profit. Now, when you do see a profit, it could be a big one. But if you've ever watched The Big Short, and who was the actor who played the hedge fund bloke? He played Batman as well. Famous actor. Anyway.
Michael Keane?
No.
Oh, Christian Bale?
Yeah, Christian Bale. You see him going through this agony of him being, wrong, and all his clients are bailing out, and he's cursing himself, and he's trying to find some salvation. But he goes back to his notes and says, "I'm right. The housing market is collapsing." And then finally he gets his payoff. That's the life of a long options player, and that's the life I don't want to live, which is why I tend to be net short.
The other thing I'll mention about that too is most people who don't have the mental conditioning, what happens is, you take 6 months of small little hits, can't make it. When your big play does come, they take their chips off the table too soon, and they'll take a 50% profit versus the 500%. They kick themselves because they were so conditioned to, it doesn't work out. They're so eager to take money off the table. So again, I like to do a blend. I think 90% of the time I'm selling, 10% of the time I'm going long.
You need to be a hardened psychopath.
A hardened psychopath is definitely a helpful requisite for trading. So let's open it up to Q&A. Again, we're talking about covered calls. We're talking about adjusting covered calls, but we can open it up to whatever questions we have. Let's see. We've got a question from Def that came in earlier. Does it make sense to buy perps if one is stuck in a call? You can't buy it back due to low liquidity. So you sold the call, low liquidity. Does it make sense to buy perps?
Yes, we did a course on this. Go back to YouTube, look at the Rogue Trader Academy channel, and the first in the Deribit series of how to deal, or first or second, how to deal with calls going wrong. Yeah. So and the message in that video is if you're going to do that, be prepared to do it early. Particularly in the current environment, you want to try and be a market maker while hedging your short gamma with perps, because you'll pay a lot less in fees. And actually, last year fees didn't matter, but this year they do. My P&L this year would be something like 50% higher if I had been carefully making rather than taking on my perps hedging, and that's significant, right? And so you hedge early, and you then might find that the hedge goes wrong, but then you've got to treat that as a covered call and actually just keep on rolling your call against that wrong purpose position until it all comes good. And that's covered in the second of our videos in the series, right?
Yeah, that's right. So Def actually had another question when I was sharing my charts, and he's asking if that information, or maybe when you were sharing, I think with the IV, if it can be found on TradingView as well. I don't know. I use TradingView simply as a charting platform. I draw all my stuffs on there. If I'm doing other types of trading, they have more elaborate tools. That's all I use it for. I don't use it for data. I use Deribit for all of that data. I don't know.
There's a Swiss firm called Levitas, is that right? Who do really awesome charts and historics for crypto options. I can never remember the name of them. I've got them in a when this video goes up on YouTube, I'll put that link to Levitas in the comment section.
Okay. Let's see here. Another question from Def too. Is a way to have these slides? No, I don't think we have a way to have these slides right now. Of course, you can always watch this on YouTube afterwards, so watch as many times as you want. Do you see any advantage in using devol future contracts?
If you don't mind letting the market makers of those contracts handle the spread for you and take a profit, yes. So if you've got a strong view on vol, so you think vol's going to drop, for example, like I do, you could just say, screw it, I'll just sell some devol futures. And what you're effectively doing is selling strangles under the covers, or what the market maker behind you is doing is selling strangles and then managing the position. And he's pricing those futures at the expected to cover for the expected cost of hedging that position. So you're just, and of course he's also pricing in some profit for himself. And if you're prepared to pay that profit for the service, definitely worth it. Yeah.
And I see
there's no calls on devol futures or puts to give yourself a stop loss just in case you're wrong. And actually, in options world, there is a thing called vol of vol, i.e. the volatility of volatility. So you could kind of do options on devol as well if you want to get really esoteric. But that's not a product that's commonly available.
And Vincent made a comment, which is true. He says that sadly it's quite low liquidity on the devol futures, so not a lot going on there.
And that's this is not Deribit's fault. There is just low liquidity across the board. I've spent the past week speaking to hedge fund managers, and lamenting that liquidity seems to be low, vol's low, and even vol is low in crypto. And they said to me, "Yeah, welcome to our world. It's the same in TradFi as well. There's literally no one out there in retail trading. I mean, I say no one with in quotes." And I'm actually going to do an article on this, and we're hoping to do a complete show on this. Basically, no one's got any money. all those stimmy checks that we got given, and all the free cash that we got out of COVID, and all the low interest rate money, that's all gone, and it's gone, right? That's not coming back for the next probably decade. And you're now going to have to live in the world I grew up in, which is where you have to actually work for a living. And pay. Well, when I first left school and got my first credit card, I was paying 30% a year on my APR on my credit card debt, and I was paying 9% on my mortgage, and we're going back to that world, I think, until there is somehow a wealth transfer from the super rich and hedge funds and banks back to people. I'm sounding a bit like Max Kaiser now, but that we're actually at a big moment, in the history of our young traders' lives. That if you're under 40, the whole of your life. No, if you're under 50, actually, the whole of your life has been lived in a Goldilocks period that the world has never seen before, of essentially free money, and the world is full of bullshit businesses that don't produce any value, employing people on massive salaries, and you probably think that's normal. It's not. Welcome to hell.
Yes, and more fun next time. Welcome to hell. Okay, all right. So, question from Dennis: is it possible to do an OCO order for the spread in Deribit? I don't monitor the price as much, and OCO will help a lot.
Is it what's OCO?
Well, that's what I'm just thinking. I'm racking my brain. Let me take a look on.
Just type it in chat.
Yeah,
and we'll come back to the question.
Yeah. I don't. Hang on, let me see here.
And then Vincent have a load of devol scripts. Oh, thanks, Vincent. That's great. So you found the URL to live eTest. Fantastic.
One cancels the other, I think, is an OCO order.
I have seen one cancel other in other exchanges. I've never looked on Deribit. I don't see it.
I've never seen it.
We would need to get back to you. We'll cover it in our YouTube. We'll mention it.
Let's see here. Dennis, do you follow P&L mentally, and do you know in advance how and when your P&L will change? Does it reflect your decision making? Yes.
I wake up. If I see what crypto's done overnight, I know exactly what my P&L is. You just get into a phase of just knowing. If you've sold 45 vol overnight and you've seen a big move, you just know it's going to be it's going to be wrong, and you're going to wake up to 48 vol and you're underwater. And if you've sold 60s and you've seen the market go sideways, then you're going to know. You just know that you're going to wake up to 50s and happy days.
Mm-hmm. That reminds me of we've got a mutual friend, Joe, who used to be a floor trader, options floor trader, and I remember he was talking about, he'd take advantage of, if a certain strike and expiry was high, he would sell it, or if it was low, he'd buy it. And most people on the floor have, Zephyr or different software systems they're using. He didn't. He's just like, well, I do it every day. I just know what it should be and what it shouldn't be. Well, thanks, Joe. Big help for me. But it's sort of the same thing. You see it every day in, day out. You just you got a pretty good idea where it's.
Yeah, you just, if you're doing this every day, you just you internalize it. You just feel it.
Sylvanius asks, okay, why not just short 2 or 3 calls positions and manage it? You seem to have open many positions, debate few versus many. So,
yeah,
go ahead.
I'll cover this. Yeah, because so there's a difference in the way that Shane and I trade. Shane trades opportunity, and often doesn't delta hedge his option positions. I religiously delta hedge, and I trade systematically. So I don't care about what strike I'm selling or what expiry, or even what it does after I've sold it. what I care or bought it. What I care about is what the vol was when I sold it and what the vol is now. And it's very simple. I will sell vol wherever I can get the highest vol, and I'll buy it wherever it's the cheapest. And every day that'll be somewhere different. And in fact, if for me, if we go sideways for 2 weeks, as happened a couple of weeks ago, what happens then is I start building up concentrations of position at a given strike or on a couple of strikes, and I see that as a negative because I've now got a concentration of risk, which makes it much more difficult for me to hedge gently. It means I've then got a spike. I've got a gamma hedge aggressively, and I will actually work to even out those areas of concentration. So I prefer to have my options spread all over the place. In fact, I call it smearing. I smear options. And one thing I've been doing over the past couple of days is buying my at-the-money options back because they've been at 42 vol, and then smearing them around the wings where I can get 51 vol. And that's just what I do.
Good answer. Yeah. Question from Jelly. I'm not sure how to pronounce that. If your last name was Roll, that'd be cool. He'd be Jelly Roll. Does it make sense to look at the Greeks when I'm selling covered calls at strikes where I want to sell my ETH? Anyway, I don't mind selling the options. I'm an options noob. I've been selling calls when ETH pumps to get a good premium.
Good.
When they expire in the money, I sell spot ETH.
Okay, interesting. Yeah.
Yeah, so, and actually, I'll just before you jump in, Rich. I think that's a great way to start. When the market does something a bit irrational, especially if you see a big support or resistance, that's a beautiful time to sell options because the volume of the IV is typically up, or you've just got that better percentage. So when you're talking about the Greeks, well, some people will just look and say, hey, every single month or every 30 days, every 52 days, whatever, I'm selling the 25 delta option, the closest 25 I can get. Fine. That's fine. You can do that, but you can adjust that strategy too. If we've just made a really big move, we've moved 20% up over the course of a week or something. Whew, is that thing going to keep going? It's probably going to take a breather. Maybe then I'll want to sell a 30 delta or a 40 delta because I think there's a bigger chance of me being of that retracing or at least pausing. So again, it depends on your bias, but I love the way you're approaching it as a beginner and waiting for those opportunities.
BTC selling off now.
But he did say he's selling spot ETH when those options expire in the money. So basically, if the market price goes above the short call strike price,
he's getting taken into cash. Yeah. So and actually, it's a great instinct to ask the question. So yes, you should take account of it. And what you'll find is that if the market does move up aggressively, it'll break through some strikes, and people will be covering their shorts, particularly in the current market where everyone is short vol. They were scrambling for cover, and they'll be buying calls, and that's your time to sell them because what was trading in the market for 40 vol yesterday will now suddenly be trading at 90 vol or 70 vol, more realistically, or maybe 60. And so, and that means in layman's terms that you're going to get 50% extra for your covered call. So definitely you care what the implied vol is. And if the implied vol is down at 40, and you don't have to put the position on, I probably wouldn't. Rule of thumb, right? I never want to sell a call less than 50 vol, and I never want to buy it more than 45 in the current market.
Current market, yeah, I think that's good. Vincent had a couple of comments too. Are you consistently earning from this delta decay, etc.? And he also asked, when you're talking about your smearing, he asked if that is basically naked ladders short.
Basically, yes. I do trade calls naked, and I also trade puts naked when they're far out of the money with high vol, provided I have some long puts nearer the money covering them. And that's a pure vol play, and that's because all the back tests I've done. Yes, you'll make money selling puts, and you'll even make money selling low delta puts, which you definitely shouldn't do naked over time. But you will take some serious drawdowns, and your Sharpe ratio won't be great. Calls are much easier to manage.
Yeah. Okay, Dennis. Thanks for getting back. Yes, we figured out one cancels the other. We aren't aware of that in Deribit. We can ask them. Vincent says he's actually testing the Leviathan API. Is available in Bookmap Digital Plus, is free, OCO brackets, etc., and can use on options. Okay, I don't know anything about that. Maybe you do.
Research for our viewers.
Yeah. There you go. Okay, I think we're at the end of the questions. That's perfect. We're exactly at the top of the hour. Great timing. Thanks, everyone, for joining us. Let me take a look at the poll here. We're still showing options expiry tomorrow. I asked if you think the market's going to move up, down, or do very little. Most are saying up now, so that's completely switched. 41%. 35% saying have little effect, and 23% down.
Yes, it's not decisive, is it? I'd say no. Expectation is basically sideways.
Yeah, I think we're all sort of in agreement there. We'll see. The vols certainly haven't risen in anticipation of anything crazy happening, but who knows? It's the market.
Oh, the question you didn't ask is what happens after expiry.
Oh, yes.
So, because I'm a bit concerned about the downside, to be honest. I'm longer puts than I am short at the moment.
Okay, so
no, that's not advice. That's just me being naturally cautious.
Well, yeah, and I suppose the poll, does it also sort of speak to what happens afterwards? Maybe, but I think it's pretty indecisive right now whether we're going to go up, down, or sideways. I think you and I are both feeling it's probably going to float around sideways without more than a 3 or 4% move, but that's just me. Okay, guys, thanks so much. Again, if you don't have a Deribit account, use the link at the top to sign up, save 10% on your fees. And you can also join our special offer, $7, 14 days access to our Telegram group. Until next week, now, our intention was to carry on with the covered calls. The last couple of things we want to talk about with covered calls next week, but we might interject a special episode next week. We're going to talk to Deribit specifically about how this market has changed so much drastically from the previous year based on a lot of research Richard has done. So either way, it's going to be an exciting episode next week. Please join us, and good luck this week, and good luck with options expiry tomorrow.